have again a look at our small video here. Okay. Let me just check if the sound is on. Yes, seems to be.
All right, let's get right into it. When it comes to investing,
to you, Dan.
Everything, I mean everything, starts with a single idea. But let's be honest, in a world that's just flooded with information, with hype, with nonstop headlines, finding a genuinely good idea can feel like searching for a needle in a haystack.
So that really gets us to the heart of the matter for this whole explainer. Where do the winning ideas, the ones that actually lead to outperformance, really come from? Is it some random flash of genius, a hot tip from a friend, or is it something else entirely?
Well, the answer probably isn't what you'd expect. It's not about getting lucky or chasing the latest hot stock tip you see online. The real edge, the secret sauce, comes from having a structured way to find and vet your ideas. It's about separating the signal from all that noise. And that, my friends, comes down to having a solid process.
And that brings us to this fundamental challenge, this dilemma that every single one of us as investors has to face, figuring out what's a real opportunity and what's just market chatter.
You can pretty much split idea generation into two big camps. On one side, you've got what we'll call spontaneous discovery. This is when you see a stock blowing up on the news, or you hear about it from a bunch of people, and you get that FOMO feeling and jump in. It's reactive, it's emotional, and frankly, it often leads to buying at the absolute worst time. But then, on the other side, there's the deliberate search. This is proactive. It's about systematically digging through data, being disciplined, and having a system to find value before everyone else does.
So here's the crucial difference. Are you just sitting around waiting for a random light bulb to go off over your head, just hoping inspiration strikes? Or are you getting out the magnifying glass and conducting a real, deliberate investigation? See, one is totally passive. It relies on chance. The other is active. It's about creating your own opportunities. And in the long run, I can tell you, deliberate processes win every single time.
So where do most investors usually start looking? Well, with the traditional toolkit. And look, these sources are still relevant for sure, but as we're about to see, they're often, well, incomplete.
Think about the daily news cycle and earnings calls. They're a classic double-edged sword, right? On one hand, yeah, they bring new information to the surface. But you have to remember, by the time something is a major headline, the smart money has probably already made its move. It just ends up creating this herd behavior, pushing everyone towards the exact same trades. The real gems are often hidden between the lines, especially in what executives don't say on an earnings call.
And what about analyst reports? You see them everywhere. But the real value isn't that final price target they slap on it. Nope. It's in digging into their models and understanding how they got to that number. You have to remember this phrase: consensus is not conviction. Just because every analyst on the street agrees on something doesn't automatically make it a great idea. And of course, we've got to talk about social media. Places like Reddit and X, they've given everyone a voice, which is amazing, but they've also turned the hype and volatility dials up to 11. A really smart way to use social media is actually as a contrarian indicator. When the chatter about a stock gets deafeningly loud, it might just be a giant flashing sign that the trade is already way too crowded.
Okay, so if the traditional tools have their flaws, what's the answer? It really takes a fundamental shift in how you think about all this. It's about focusing on your process way, way more than on any single lucky find.
I love this quote. It just captures the idea perfectly. Think of your investment strategy as this powerful engine. Well, without a consistent, high-quality flow of ideas, the fuel, that engine is just going to sputter and stall. You'll be stuck reacting to whatever the market throws at you instead of getting ahead of it.
So, what does a truly structured, deliberate process actually look like in the real world? Let's make this tangible and walk through a case study, the SATIF stock selection method.
Now, this isn't some kind of magic black box. It's a rigorous and maybe more importantly, a replicable 6-step process. As you can see, it moves methodically from a broad watch list all the way down to a single high conviction pick. The key thing here is that every single step is defined and repeatable. So let's break it down.
Step 1. It all starts here, a full week ahead of time. The team builds a short list of just 5 candidates, pulling them from a pool of top-performing gurus and proprietary strategies. They're not just looking for trendy stocks. They're looking for stocks with the highest expected return compared to a basic ETF. All right, once that watch list is set,
The real deep dive begins. For each of those 5 stocks, multiple performance reports are generated. This is where they get put under the microscope, getting scrutinized based on hard data, looking at recent performance and, critically, their risk-adjusted returns.
Now, here's where things get really interesting and modern. All those detailed reports are then fed into ChatGPT to be analyzed and ranked on a simple 1 to 5 scale. Using AI like this helps remove human bias and speeds up the whole process like you wouldn't believe. And the rule is simple. Only the best of the best. The stocks that score a 4 or a 5 get to move on to the next round.
In step 4, it's simulation time. They build a hypothetical portfolio worth $100,000 using those top-scoring candidates. They use some pretty sophisticated financial models to figure out exactly how much to invest in each one. It's basically a stress test, a dry run, in a real-world scenario before any actual money is put on the line. From that simulated portfolio, they make the final selection. And the criteria here are super strict. They are looking for stocks that showed 2 positive signals at the same time: strong performance over the last month and positive momentum in the last week. A stock absolutely needs both of those to get top priority. And finally, before that pick is released to the public, it goes through one last round of checks. They're looking at any recent rating changes, price volatility, target revisions, you name it. The pick is then released on a strict, predictable schedule, the 6th working day of the cycle. See? That's the power of a disciplined process.
So, after seeing a process that's so structured, you might be thinking, wow, that's a lot. That's great for them, but what about me? And that right there is the real takeaway.
The big question this all boils down to is, can you do this too? Can an individual investor actually replicate or adapt a process that's this rigorous? And the answer is a simple, powerful yes. Absolutely. Look, the point isn't that you have to follow this exact 6-step method down to the letter. The point is that having a framework, any framework, empowers you to build your own investment engine. It's about creating a repeatable process that fits your style and your goals.
And that really is the ultimate takeaway here. Investment ideas are everywhere. They're cheap. But turning those ideas into actual returns, that takes discipline. The best investors in the world aren't just rich in ideas. They are obsessed with their process. And that is where the real sustainable edge is found.
Okay, so we are done with our little video. Let's now resume our discussion. And let's begin by highlighting which approach one should follow to source ideas. Of course, we can generate ideas in any way you can imagine. Some people have their ideas when they are in the path, some when they are traveling, some when they are watching the news, some when they are talking to friends, some by looking at what our friends are doing, looking at what other investors are doing, and so on. So you can have all sorts of ideas coming your way through the various approaches, you know. But these are typically what one may call casual methods, or let's say unstructured methods, not structured approach. But you can also follow, and there's nothing wrong, by the way, there's nothing wrong with getting your ideas, whatever they come to you, without thinking too much about that. There's nothing wrong with that. So as long as that, you should take treat your ideas, they're just ideas, and have to refine them and to do a due diligence on them. So there's no problem with the casual method. But of course, you may do better if you use a structured approach. Let's say if you search for your ideas in a structured way, and if you're looking for your ideas in a structured way, you can do it either top down or bottom up. That means that you can start from the whole market and then narrow it down to a small group of stocks that you can then go to look at them, or you can start with a stock that got your attention, and then from that stock go and look to their peers or competitors, and then look at those, and from those look at others, and so on. You can really start from the bottom up or the top down. And our platform, the Scientific platform, allows you to do it both ways. It's a matter of, but we'll probably be better off if going to use a top-down method. So at least if you have the time and the patience to work out in a top-down manner, and that's the option. So, but again, you can use any of these methods, casual, structured, either top-down or bottom-up. That doesn't really matter as long as you then complement those ideas with a good due diligence process. Okay. But you can also get ideas that are sold to you. Okay, so you can get ideas that you didn't found them, but they were brought to you, and they are usually brought to you through media and through research. And again, the media and the research source of ideas can be very useful, but can also be very misleading if those ideas are not are simple marketing of particular interests. Let's say if you have say a big investor who has a big position in a stock and is trying to sell it down, so probably he will praise all how fantastic the stock is, how much money he has already earned, and so on. But while at the same time he's trying to sell it, and he's selling down or reducing its position. And the other way around, if someone wants to buy, of course, they will play down the stock and say, well, this is a lousy company, you're having all sorts of problems, the management has changed, all sorts of bad news. So the way the people express their good and bad news depends if they are really being truthful, or if they are just making their point that interests them, if they are interested in moving the stock up or down, so that influence the opinion that they have. So it's very important then again to see if how you get this median research. Is it paid for, or are you getting it free? If you get it free, of course, you cannot ask for much. But if you are going to be option between paid and free, you really need to choose the paid research. Why? Because if you are paying, at least you can complain, and you can say, listen, guys, everything that were suggesting to me were lousy stocks. So I lost a lot of money. So what are you doing? So I'm going to stop my subscription, or I'm not going to do that. So in the way, whether you get these opinions in a paid way or a free way, of course you need to consider which is better for you. And I would certainly advocate that you rely more on paid research and paid media than on free research and free media. But it doesn't mean that all free is necessarily bad, as long as you can understand why they are advocating up or down, or if they are playing down or up a stock. So it's not necessarily bad. So when looking at tips, the tips that are being brought to your attention, you have to consider this question whether they are paid or free, but you also need to consider where the reputation of your of the research that you are receiving is worthwhile. And of course, when dealing with research, we have a basic problem, is that research rely a lot on payments to the investment banks that produce that research, and the investment banks rely a lot on service they deliver to their clients. And of course, if they are giving a bad opinion about their clients. The clients will complain and probably cancel their service with the bank. So in a sense, you know that research and tips that is brought to you by the so-called sell-side research, especially the investment banks, might be biased. And you notice that when you look at the so-called consensus of estimates in the consensus of recommendations, you look that they usually are on the high side, not on the low side. So if you're looking at that, so you have to bear that in mind, because you have to be realistic and know that that's the way the system works. Because that's so. If you're looking, say, comparing the SADIF research, we have also our research, as you probably know. Our research is, in that sense, is quite independent, because, and the reason why it is independent is because it is not generated by humans, but it's a research that is generated by algorithms. But of course, you can feed the algorithms to give you the results. But in our case, because we are using doing the research using the same methodology for 40,000 companies in 30 countries, of course, we can't do any manipulation of the input data that we provide to our algorithms to generate the research. So that would be quite impossible. And so we, like some other research providers, can guarantee some degree of independence and exemption from conflicts, right? But I would say that that's the reason why research is better than the average research. The reason why we consider that our research is better than most other research providers has to do with the quality of the models that we use, because our research is not just some kind of scoring or typical, which is typically used, not some kind of drawing nice charts and so on, but is actually the way it is structured, and some what is underpinning our research, which is our rating system. So we have a rating system based on advanced math that has been proven for now almost 20 years, and that rating system is the basis of our research, and therefore the quality of our research depends on that rating system. And as long as we keep testing and checking the ratings, and they are working fine, and we use quite a lot of ratings, as we will see during our program, then we can trust that our research will always be among the best. In fact, or probably the second best. Some time ago, some guy at Bloomberg told us that our research, or at least our price targets, were the second of the best among all the second best. So anyway, but it's not discussion now. It's not about the quality of our research. It's just to point out that, in fact, when we receive research and we receive tips, etc., and so on, we need to have to be sure that we are getting independent and quality research. Now, we have introduced 1 year ago. Actually, I've just completed 1 year what we call SADIF tips. And these SADIF tips, which we published for 26 countries now, are based on a specific methodology that we follow. And I would like to show you the methodology was slightly described in our little video. The whole process. So the whole process starts from picking stock tips from our strategies. We have a number of strategies. We'll talk about after in the next even today. But from those strategies, we pick the top strategies and select about 30 around 30 stocks every day. Those stocks are then added to a watch list. And that watch list sorry, but before that watch list is going, those stocks are going through a very detailed due diligence process that includes both our research and the use of artificial intelligence, and also a program that allows us to identify the stocks with the best prospect in the near future, and so on. So it has a very rigorous process, and that rigorous process then leads us to pick daily watch lists. And after a week or so, we then merge all those watch lists into a single watch list. Out of that, then we select two stocks to make them our stock pick for that particular week. So let me show in our platform how it is done. Okay. And I will show you the stock picks that we have produced for the US in the last 12 months, since February last year. And we have here the stocks that we have picked. And as you can see, we measured in FEI, our return is almost 25%. But if I want, of course, to change this to US dollars, if I want to know how much because the US, I just change the currency here and express it in US dollars. Okay. So that it's not much of a difference. So the return in US dollars would be 24%. If you compare it with SPY, you see the SPY did about 9%. So we are actually we have a pretty good outperformance of the US market so far. And of course, we have here in this tool not only all the positions that we have taken, but we can, of course, order them by the winners and the losers. In the US, we have been very good, so we have very few losers. We have just actually a few. Wait, I'm not sure if okay, here we have. Funny enough, our big loser is Microsoft. So one of the big stocks, one of the famous 7 stocks, so the Magnificent 7, is our worst performance in the US stock list, as you can see here. And we can see how badly we are doing. And in fact, we can see that it has here a yellow line. It means that it's probably getting to a position where, according with our rules, we will have to sell them before our loss gets bigger. So right now it's underperforming the market by almost 27%. So it's outperforming the market by almost 27%. During the period we have held them since August last year, they never managed to beat the market. So that's been always been. So probably very soon we'll be forced to sell the Microsoft if they don't improve. So we'll discuss later why we come to this conclusion. But you see that we don't have many. We have a few, quite a few losses here. None on the red yet. So we don't have any on red. But you have a few yellow alerts, which means that we should look into them, whether they are positive or like these ones are still earning money and so on. So that we should look at this. Okay, but how did we come to this list? Of course, these have to be compensated by big winners, and we have a number of big winners. You saw like this one almost double. This one again almost 90% increase in one year. So we have big winners here as well, and those explain why we outperform the market. In fact, it's quite common that after you have a reasonably number of stocks, that typically you end up with a distribution of returns that is something like this. So basically, it's just an example, but if you look at how they are above the market, you usually have more or less 25% above the market. You have 25 below, which are losing money, and then you have the other 50% are somehow in the middle. And usually, if you want to have a winning portfolio, you have to make sure that these lose much less money and these make much more money, because usually the middle, they are sort of they have a small gain, but it's not what makes a big difference in a portfolio. What makes a big difference are the big winners and the big losers. And you can see here that we have been very fortunate in not having many big losers. In fact, we have just a few big losers and not very without the big loss. But how did you come to get these tips? Let me show now a little bit what we have done before that. And here you have watch lists that we do for the US. And you can show you the process. Let's take a bit to open now, but it'll show you the process that I was describing, that we start by selecting daily tips, then we aggregate them on a weekly basis, and then we, out of that aggregated, and after monitoring them for a full week, then we select the picks that go into our trading, okay, into our positions. But it's not open for some reason, so I will just close our this section now, and we can move to the final topic for today, which is okay, here we have, you see, we have here for quite a number of stocks in our watch list, and they have a second portfolio. Then we have I think this is weeks. I'm not sure if I'm doing it correctly, but here we have the ones that we select in every date, and we can go back and check what we have been doing. Okay, this is enough for the idea generation.